Stock markets are where fortunes are made and lost. The intelligent investor can only teach you so much, but to understand markets even better, we'll have to look back in time. After all, market crashes are never random. In this video, we'll look at all the major stock market crashes, analyze similarities between them, and pinpoint the biggest factors attributed to market crashes. And go! This was the first recorded market bubble in modern capitalism. The Dutch were high off spices and had cash to blow. Tulip bulbs were all the rage and investors were trying to make a quick buck by buying and selling them for a profit. Often, huge loans were pulled out to gamble on the frenzy of speculation. It was pretty heinous due diligence, but it went on for a couple of years until tulip prices hit 20 times annual income, and then the bubble popped. This was in the middle of the Dutch golden age that continued almost a century longer, so it's more of a good classroom example of a market bubble than a real economic meltdown. The United States was new, broke, and trying its best. Lots of money was borrowed from American and English banks to finance land speculation, but the land prices rose fast and way too much was being loaned out. Prices eventually fell and mass bankruptcies followed, but it was no slap on the wrist. If you couldn't pay your debts, you were often sent straight to jail. Oh, what's that you hear? The calming chirping of nature? The snort of the buffalo? The call of the eagle? That's right, the West is calling, and American settlers were manifesting land. Economists were not creative with their naming conventions, nor are American investors with their causes of market crashes. Land speculation, easy credit, and bad loans again led to America's first major recession. There became a huge distrust of banks and a growing political campaign to drain the centralized elite banking swamp. Oh, Andrew Jackson, what are you up to this time? Oh, okay. AJ vetoed the recharter of the Second Bank of the United States and instead distributed the money to various state banks, which gave out many reckless loans to land speculators. Shocker. Andrew Jackson then required all public land purchases be made with gold and silver instead of cash. Land demand tanked, the money supply choked, and banks began to fail. Funnily enough, after his bank war, they slapped the guy on the $20 bill. So, yeah, whatever. Alright, enough land speculation, that's old news. The next greatest thing? Railroads. Large risky bank loans were taken out to fund big train projects and the railroad market was forming a bubble. Then, New York City's oldest flour and grain company failed, which sparked mass exodus from the market. Silver was getting demonetized, the Europeans were fighting, and railroads were inflating yet another bubble. The result? A full-blown financial crisis that kicked off 2 decades of economic stagnation, better known today as the Long Depression. This was a relatively minor banking crisis in New York City, and weirdly it hit at the end of the recession. Plus, no surprise, too many over-leveraged railroads. But JP Morgan and his other banking buddies swooped in to help shore up the collapsing banks. 2 major railroad tycoons had beef over control of a railroad company, and each secretly tried to buy up all the shares. At the time, though, everyone else was shorting the stock. The increase in price and demand of shares caused a short squeeze, where shorts had to cover their position by buying back shares at market price or face bankruptcy. It's considered the first major short squeeze in US stock market history, and Northern Pacific Corner, the company getting squeezed, ended up being the 20th century GameStop. Some investors tried to get rich by cornering the stock of a copper company, but blundered. A banking crisis hit the US, and big bro JP Morgan stepped in again to help. This market crash led to reforms, which would ultimately create our beloved Federal Reserve System. Stock investing was a national pastime, and buying on margin was the norm. Things were going great for investors until one Wednesday your grandma starts talking about how she's heard about stock trading is now 50x leveraged on Ford. That can only mean one thing: there's a huge bubble. But when you go to pull out your money the next day, it already popped. After a few days, stocks were down 30%, and by 1932, the market had lost 90% of its value. This triggered the Great Depression, the largest modern economic depression ever. As things were just looking up from the Depression, the market completely derailed again. The Fed raised interest rates, FDR cut spending, and taxes increased to balance the budget. These macro adjustments derailed any recovery momentum, and it would take a war to get out of the slump. Nixon was a finance bro at heart. In a transition of modern monetary policy, the US abandoned the dollar's gold standard, leading to a system of floating exchange rates. The long-term effects were good, but in the short term things got crazy. Currency markets became extremely volatile, and the dollar quickly depreciated. Combine that with insane interest spikes, massive oil shortages, and political chaos, and you get a 45% decrease in market value in just 2 years. In a single day, the market dropped 22.6%. Computerized trading models and investor panic selling culminated in the worst one-day percentage drop in US history. After all that, stock exchanges needed a new system to give investors time to cool off and prevent future panic-driven sell-offs. Circuit breakers were established to automatically pause trading temporarily to prevent this from ever happening again. Spoilers though, it happened again. This was a currency crash, not a stock market crash, but still important to know. The UK was going through a recession, and the collapse of the pound was the tipping point. Famously, George Soros became the LeBron James of Forex after making one of the greatest trades in history. He bet the government couldn't defend the high value of its currency and gained $1 billion from his short. A huge win for hedge fund bros, but the UK did not do so well. The government spent 27 billion bones to prop up the currency to no avail. When it couldn't defend its currency, Thailand's economy collapsed. Once the Thai baht was devalued, panic spread across Asia, hitting Indonesia, South Korea, Malaysia, the Philippines, and more. Currencies tanked, stock markets crashed, and governments scrambled for bailouts. Investors were throwing money at anything with a .com in the name, even if it had no revenue, no product, and sometimes no actual business at all. Tech stocks soared, and the Nasdaq nearly 3x'd in just 2 years. When everyone realized these companies needed legitimate business models, the hype train derailed. Trillions of market value was lost, and thousands of companies died. Silicon Valley went from IPO champagne to microwave ramen in just a matter of weeks. Banks were giving out mortgage loans like crazy while doing little due diligence. They bundled all of these risky mortgages with safe mortgages into collateralized debt obligations, or CDOs, and sold them to investors. The idea was if you mix enough junk together with the good stuff, it becomes safe. It didn't. The ongoing housing bubble popped and massive defaults rocked the economy. Major financial institutions were deemed too big to fail, and the government stepped in to bail them out. The Fed printed money like it had never before, and the world entered the worst economic crisis since the Great Depression. This one kind of sucked, but it did give us Down by Jay Sean and Lil Wayne. So, you know. Thanks to circuit breakers, flash crashes like Black Monday would never happen again. On May 6, 2010, the US stock market had a flash crash and dropped nearly 1,000 points in 5 minutes, and then rebounded almost as fast. One trading firm used a sell program to dump $4.1 billion of E-mini futures on the market, which caused other computer algorithms to kick in and snowball into chaos. A big trillion-dollar oopsie that lasted only a few moments, and at the time was the largest intraday points drop in US history. Markets tanked on fears of a global pandemic, which became reality. The world economy hit a brick wall and layoffs were rampant. The Fed started printing money like crazy, and the US government handed out huge stimulus checks to affected Americans. In comparison to the drop, the stock market actually recovered relatively quickly. But massive inflation was on the horizon and would cause another stock downturn just 2 years later. So, after all that, what actually causes market crashes? With all of these examples, there's obviously a lot of repetition that occurs. We can attribute this to 3 main causing factors: external shocks, speculative mania, and over-leverage. So here's the usual script for market crashes 101. Prices get too high, some event sparks fear, leverage positions implode, and the whole market spirals down. Now, not every crash fits that mold perfectly, but the pattern shows up again and again. Crashes may be spaced years or even decades apart. That's why even seasoned investors can forget warning signs. So, study the history, recognize the red flags, and maybe next time you'll be the one who saw it coming. Because remember, no bull market dies of old age. Market crashes are never random. If you liked the video, subscribe, it helps a lot.